Okay, we're ready to finish chapter 10. This is not going to be a very long video. There are only about 3 or 4 slides left to go in the chapter. We almost finished the complete thing in class, and I'm sorry we didn't get it done, but we ran out of time. So what I want to do is cover the last section of chapter 10. It deals with how we measure gross domestic product and how we compare it amongst different countries. This will be the basis, chapter 10 will be the basis for your quiz on next Tuesday. So as I said, this will again be a short one. I want to start with the last one we left off with, and that was measuring domestic income. So let's take a look at that again. There's a couple of things you should be aware of. So what we said was consumption, investment, and government spending. Now the title of this overhead is domestic output and national income. When we say that, we mean only the stuff that we produce. So international trade is out of this calculation. So if you want to measure domestic output and national income, it would just be consumption, investment, and government spending would equal GDP. So we said, okay, one of the things I have to be careful of is we don't want to double count. So no intermediate goods, no work in process, only final goods. Not the car bumper, but the total car. Intermediate goods are work in process. Again, the bumper is work in process. The car is not complete. You can't drive it with just a bumper, obviously. So final goods are final goods purchased by consumers for consumption. They're going to be destroyed. They're going to be consumed. Okay. Now, what we did then was we also said we don't want to include public transfer payments, which are like our transfer payments that we pay for Social Security, Medicare, etc., food stamps. None of that's included in our calculations. Secondly, private transfer payments. This is the one where Uncle Fred gives you $2,000 to go to college after you graduate from high school. Or this is where you cut lawns for neighbors and they pay you. Or this is also the case where you do some babysitting and you get paid. It's not in the gross domestic product calculation. As well, stock market transactions are not included. Next class, before you take your quiz, I'm going to bring in sheets of paper from the Wall Street Journal and give you an idea how you read stock market transactions. We'll get into that further later on in the course, but I think it'd be a good idea to kind of introduce that subject right now. All right, and goods have to be new and not secondhand. The car you buy from the dealer is a final sale, a brand new car, that is. A secondhand car you buy from the dealer is not a final sale, and it's not counted in our statistics for gross domestic product. All right, we started on this other national accounts. And this is important because there are other things that are involved that do have an influence on our GDP calculation. And one of the most important is disposable income. I use the example on the board today where you're working for $7.25 an hour. Your employer takes $1.25 for FICA and other things, and you end up with $6 per hour. Now that $6 is what we call disposable income. In other words, there's only 2 things you can do with that money. You can consume it or spend it. I suppose you could burn it if you want to, but that's kind of silly. So either consume it or spend it. We buy something with it or consume it or save it. We buy something with it or we put it in savings. There's only 2 things that can happen with money that we have, this disposable income, after taxes from our paycheck. Okay, in terms of disposable income, this is the equivalent of your take-home pay on a national level. So it's take-home pay for everybody in the country is disposable income. It represents what consumers have available to spend after other payments and taxes are taken out. Again, we get paid $7.25 an hour. We take out $1.25 for taxes and other payments. All right. You know what? Let's go back to that a minute. I want to talk a little bit about savings. I started on it. Savings, as I mentioned in class, is a double-edged sword. If we save out of current income, in other words, the paychecks we get every month, if we save out of that, that is money taken away from consumption, and therefore it doesn't help the economy. It doesn't help grow GDP. That's in the short run. In the long run, however, savings are there for investment purposes, and they can be used to do investments which would help the economy. So as I mentioned in the class, again, savings is a double-edged sword. In the short run, it hurts GDP. In the long run, where it's end up using for investment in capital goods or economic investment, it does help GDP. Now, one of the things we didn't talk about, I mentioned it when I showed you the chart that you've seen before on flows, land, labor, capital, entrepreneurial ability, and then we talked about the income approach to calculate GDP. And that approach was basically we added rents, income, all the money that we receive in interest, all our wages, etc. That's the income approach. Whether you use the land, labor, capital approach or the income approach, you do end up with the same number, which is gross domestic product. So the income approach is a value-added approach. We take the addition and the profits, etc. So the sources of that measurement are wages, rent, interest, income from small businesses, and corporate profits. So let's take each one. In terms of wages, when we earn money, your employer submits that wage data as well as the payments for FICA, F-I-C-A, for you and for him to the federal government. So the IRS knows exactly what the wages are at any point in time, monthly, quarterly, etc., annually. Take the case of rents. Now, the way the IRS gets a hold of the rent is everybody has to file a tax return. That tax return includes income from rents. Okay? Interest, same thing. You file your tax return and you have to record on that return any interest income that you made. Income from small businesses. Again, you file your taxes for yourself personally if it's a sub-S corporation, which is a small business corporation, or even a small entrepreneurial or sole proprietorship. You file your income taxes and you report your income to the IRS. And lastly, of course, corporate profits. Every corporation has to file a corporate tax return at the end of every year. Sometimes they file it fiscally, which would be less than, which would be a different 12-month period from January to December. It could be any combination of months, but it's a 12-month period. So those 5 things are the way we calculate GDP from the income approach. All right, nominal GDP versus real GDP. Now, we talked a little bit about this, and this is where inflation comes into play in our GDP calculation. Nominal GDP is a gross number. Always think of nominal as gross. Nominal means that it does not have any adjustments to it. It's just raw data. Real GDP is the opposite. It's adjusted for things that happen. In the case we use here, it's for the most part inflation. Okay. So raw GDP or real GDP is the raw GDP adjusted for, real GDP is the raw GDP data adjusted for inflation. So real is adjusted for inflation. Nominal GDP, we divide by the consumer price index times 100 equals real GDP. I use the example on the board. Let's assume, for instance, that nominal GDP grew at 4%, but the inflation rate in the US is 2%. We deduct the 2% from the 4%, and we get a real GDP growth of only 2%, not 4%. 4 would be fooling ourselves because it includes price differences which don't measure and don't represent real growth in the economy. All right, the underground economy is not part of this. Drug dealers don't file an income tax. People that pay in cash You receive income for cutting that lawn. You receive income from cash, from babysitting. None of those, that's considered the underground economy, and it's not part of the calculation. I use the example of New Yorkers who use cash as a leverage to get work done, let's say on their homes, for less money than what they would have to pay if the contractor had to report it as income. So they did a survey and they found that the worst countries for the underground economy are Bolivia, Zimbabwe, Peru, etc. I think these are in your book. If not, it's not significant. The important thing is that there are underground economies in every single country, some bigger than others. I'm not sure we know, for instance, how big our drug underground economy is, where drugs come in from Colombia, Bolivia, and places like that. Okay, so that's it. Short, sweet, and to the point. Um, don't forget your quiz on Monday, or Tuesday rather, is going to be on chapter 10. We'll go through some of the things I covered here. Go through this and make sure you're clear on the distinctions and some of the things that we have talked about. PPP, for instance. We talked about that at the beginning of the class, probably in the first week of the class. So you might want to go back and look at your notes on PPP. Okay. These are things that you need to think about and how PPP works. It will be on your quiz. Something else you may want to look at is go through the book and make sure that you've picked up everything in the book. We will, of course, use the book on Monday morning before you take the quiz. We'll go through it. We'll look at some things that we may or may not have covered in the overheads. So anyway, guys, have a good weekend, and I'll see you on Tuesday. Bye-bye.